Well, with so much volatility in the equity markets, many investors are looking at other ways to guarantee returns, and there is a growing number of calls for portfolios to be rebalanced towards debt products. For more, we're joined now by Mark Todd from FIG Securities in Sydney. And Mark, good morning to you. Paul Keating, Gary Weaven from IMF and David Murray have all said portfolios should really be rebalanced towards those debt products. Are you seeing any reaction from investors to that?
Yes, good morning. Yeah, there's certainly some fine testimonials. I think it's been fair to say that prior to them even coming out, we've seen a lot of interest in people moving away from the equity market and into term deposits initially, and now moving more into the debt markets. So there's a growing comfort around the debt instruments that people are, looking to get some certainty around their returns. So it makes a lot of sense with the volatility being what it is now.
What sort of assets are they really trying to buy? Where's the focus?
I think around you can see people coming into some semi-governments, but predominantly 99% of the focus is in the secondary market and bonds, and it's around the expected return, say 7 to 9%. So they're looking at things like South Bank, Praeco, so debt around a specific initiative. So whether it be, a building, the Queensland TAFE, whether it be an Investra, an inflation-linked bond. But they're looking for, stories around assets that they can understand, and therefore they can see whether the borrower will be able to meet their commitments.
Do you think this move is going to see a bit of a further developing, I suppose, or deepening of our market, in turn the secondary market getting some support?
Yeah, clearly. I mean, if you charted the business that we're seeing at the moment, it's been some considerable growth. So that becomes a self-fulfilling prophecy, where people who would have normally been in the equity market are now buying debt. So people who can issue debt will come into the market and start to issue debt. So it works both for the borrower and for the lender.
Traders have been complaining about that for some time, so it'll be good to see if we get a bit of positive movements towards that sector. RBA really highlighting the uncertainty in the market yesterday. Rick Battolino speaking out. How are bond market investors reacting to the uncertainty?
I think it would be fair to say that the bond market don't expect there to be a reduction in any interest rates or a hike in the interest rates. I think they think it'll stay around these levels. Rick Battolino made a point of constantly, and I think old hands in the bond market are worried about inflation, and he pointed to that issue around inflation. So it'd be fair to say that they'll be looking for inflationary drivers to affect their expectations in interest rates. But at the moment, I think the majority of people think that they will hold at 4 3/4 for as long as they can.
Yeah, indeed. What are you seeing in terms of, I suppose, coming out of offshore markets then?
That's a tricky one, because there's such a heightened uncertainty around, particularly in Europe, where it's very hard for people to borrow money in Europe at the moment. So you've moved from a bank crisis into a sovereign crisis. So now it's a political issue, and so we see a lot of people very nervous about Europe in general, and look at it if it's not going to be in a recessionary mode, it'll be by default a recessionary mode.
Yeah, right. Well, Mark Todd, FIG Securities, appreciate very much your comments this morning.